Hey there, everyone.
Hello,
Jeanette.
Oh,
good evening.
Hi, Matt.
Hi, everyone.
How are you?
So Dr. Cook, should I get things going since I'm the representative or?
Yes, please, if you don't mind. I believe Nanette, right? Mary Kate's our one trustee today. Our committee of one, of course. Thank you, Mary Kate.
Absolutely. So I guess I can convene this, right? This subcommittee meeting. And take roll. Yes, present, but I know Nanette, you want to do that. So I don't know if we have to, but
Well, Mary Kate Murin,
present.
thank you.
So Matt, I know we have you really looking forward to seeing what's going on. And if you could just lower that, there we go. Great, the calendar, and we'll start with the agenda. Dr. Cook, I'm going to have you jump in with some of this also too, please.
Of course, yep. And again, you did the hard part. We've got Tony Montemagni here, who's always there as part of our sounding board. But I think between Andrea and John Truden, we're just handing it over to Matt, correct? Yeah. All right, Matt, the floor is yours. Obviously, these are always helpful check-ins for all of us on where we stand with our portfolio.
Perfect. Sounds good and great to see everyone. I'm just going to start off by sharing my screen. Can everyone see my screen? Perfect.
Yes.
Just want to start off by saying it's never too early to throw out a save the date. We do have our client conference, September 26th and the 27th of this year. It's going to change locations. It'll be in Boston this year. Traditionally, we have it in Newport. Everyone is more than welcome to attend. It's a great event. We have a lot of informative speakers and also breakout groups. So more information to follow on that as the year progresses. And then we'll jump right into our governance calendar. As you know, each quarter we focus on a different area of governance. This quarter being the fourth quarter, we're focusing on the allocation area of governance. So the reason why we're looking at the allocation focus this quarter is we recently came out with our new capital market assumptions. We retested the portfolios and we did make adjustments to the overall asset allocation at the sub asset class levels and did make some tweaks along the way to some managers. So we'll review that with you today as well. Starting off kind of as a backdrop though, we'll look at some themes for 2023. As you can see here, there's 3 themes listed: persistent volatility, moderating inflation, and bear market bottom. Starting with the first, persistent volatility. So the last 10 years, when you really go back and think about it, what we saw was a low interest rate environment, low inflation, low growth. And when you think about that, you put that together, you add on accommodative monetary policy, it really made it for an environment of abnormally low volatility. That was all put on its head in 2022, where we saw high inflation, high interest rate, and high volatility. So going forward, we do think that in 2023 and beyond, we'll see increased volatility. And that's another reason why we're making slight changes in the portfolio, as we'll talk about in a couple of slides. The second is moderating inflation. As you'll see in the print around the news and reading different articles, you'll see that inflation is starting to slow down and roll over. Now, the Fed has a target of 2%. We do not think that we will get to that 2% target this year, but we do think you will see inflation come down throughout the course of the year. So that is good for everyone, but I think the Fed does have some more work to do to get to that long-term target of 2%. And then the last is the bear market bottom. As you know, we're not market timers, but we do like to look at historical trends and patterns. And one nice pattern that we did see in 2022 is with bear markets. And that is when multiples in bear markets tend to come in first, and that is then followed by earnings. So when we look at the pullback in the equity market in 2022, it's 100% attributable to multiple compression. And the tail end of 2022, we did see earnings start to roll over and contract. So that's a positive sign for the tail end of a bear market. You pair that with a less hawkish Fed, we really do believe that we are closer to the end of this bear market than we are to the beginning of it. And then, as I mentioned a couple of minutes ago, we did update our capital market assumptions. What we do on this page is, this is our 20-year forward-looking capital market assumptions. We break it out into 3 different categories, as you'll see on the page here: fixed income, global equity, and real assets. As you'll notice, the real changes, as you'll see represented in this column here, year-over-year change, is represented in the fixed income markets. You'll see a drastic increase in our expected returns, really about 2% across the board, 2.5% in the fixed income market. And that is really attributable to the base case and rates, we saw the Fed increase rates in the short end of the curve, but we also saw the 10-year increase dramatically over the course of the year. So when fixed income has a strong starting point, we'll have better fixed income returns in the future. But as we look at global equities, we did not increase our overall returns much. And actually, you see at the US domestic level, we actually decreased it by 0.1%, so not a lot of movement there. And then a slight increase to broad real assets. And just as a reminder, broad real assets is categorized by global real estate, global infrastructure, commodities, natural resources. So a hedge against inflation. We also like to take a look at the investment policy statement this quarter. As we do make changes, we want to reaffirm that the target allocation is in line with the policy and also in line with the asset allocation guidelines. So the bands around the target allocation. So all the changes that were made post quarter end in January are in line with the IPS and the IPS ranges. So nothing to be concerned about from this standpoint. Looking at page 11, you can see this is our Frontier Engineer. It's our proprietary asset allocation software where we're modeling out the portfolios. The top line here, where you see the long-term 2022 portfolio target asset allocation, this is the allocation that was in place in 2022. Diversified portfolio covering multiple asset classes. And then as we work our way across the page here to the forecast section, you can see we forecasted this portfolio to have a return of 8.1% with a volatility or standard deviation of 12.9. Now, what we did was make modest adjustments underneath the sub-asset class level. So you can see the next line item down here is 2023 target allocation. You can see here that the broad asset categories were unchanged. We still have 25% of the portfolio in fixed income, 59% in equities, 8.5% in real assets, 7.5% in alternatives or hedge funds. So the real change, as you can see here, is in fixed income. What we did was we trimmed back the unconstrained bond holding and added in two new asset classes. We added in dedicated TIPS position, so that's Treasury inflation protected securities. And we also added in high yield bonds, dedicated exposure there. Another slight adjustment we made was we took 1 percentage point away from international equity and gave it to domestic equity. And that is just as a nod to the global opportunity set. Over the course of the year, we saw the All Country World Index move closer to a 60-40 breakdown rather than a 55-45 breakdown. So just moving more in line with that breakdown. Any questions on our modeling or any of the governance materials that I showed so far? On the next page, I'll actually show how the portfolio has been implemented and where it stands from a manager and target asset allocation perspective.
Matt, I just want to check on sort of my read of all that, because that framing is obviously really important in it. I think again speaks to how solid Fiducian has been with showing us just what kind of a foundation we have underneath the approach. But one, let me give Tony a chance to sort of offer certainly a professional perspective given his line of work. For me, if I have this right, you noted the standard deviation at 12.9%. I mean, obviously that's a lot of spread, plus or minus, right? Do I have that just speaks to the level of uncertainty and volatility. It could be, if you got the annualized rate at, let's call it 8%, it could be 8% plus 13 percentage points higher or minus 13 percentage points lower. I mean, that just speaks to the sort of times we're living, if again, I'm reading this correctly.
Yep, by definition of yes, correct. Yep. Any other questions? Nope. So this is how we actually implemented those small tweaks at the sub-asset category level. So you'll see here in fixed income, we added in the Schwab Treasury Inflation Protected Securities Fund at a 1.75% target. We decreased the unconstrained bond holding, which was represented here by BlackRock Strategic Income Opportunities, from an 8.5% weighting to 5.25. Added in our high yield exposure here through Artisan High Income Fund at 2.25%, and trimmed back Brandywine, the global bond manager, slightly from 2.5 to 1.75. That's the most dramatic change that we made in the portfolio, but we really think that we're adjusting this portfolio prospectively, given what rates have done this past year, to really have a successful future. Looking at domestic equity, if you remember back to where the portfolio stood, we did have a slight value bias through the Diamond Hill Fund, All Cap Value Select. We did terminate this manager in January, so there's no longer a value bias in the portfolio. We took those proceeds and deployed them to the mid-cap index, as it's represented right here, increasing its target weight from 3% to 7%. And also the additional percentage point came from the international equity portfolio. Any questions on the overall portfolio changes?
So you just wanted to, Matt, you just wanted to move away from a value tilt to more of a blend across U.S. equity?
Exactly. And as you'll see in a couple of pages, when we start looking at the individual manager performance, it really did serve its purpose and had a nice run in performance. But we thought it was time to move away and go to a more structured market cap neutral portfolio.
Okay.
And as we look at the capital market section now, we did touch on the volatility, the first bullet point in the upper left-hand corner, but just to give a visual representation of that, in the upper right-hand corner, what we're looking at here is the S&P 500, and it really is tracking the number of days where the S&P 500 trades up 1% or down 1%. So in 2022, there was 121 days. That is the highest count that we've had since the global financial crisis in 2008. So it really just shows the level of volatility there was from a trading perspective and just magnitude in the last, call it 15 years. And what's impressive is, or eye-opening, maybe not impressive is the right word, it is double the long-term average, which sits at 65 days. I've already talked on the second bullet point, but the third one is actually really jumps out to me. So we've talked about this, both Mike and myself, throughout the year. The aggregate bond index had its worst year on record. So since its inception in 1976, 2022 was its worst year. But the one positive of this was it pushed yields up higher. We haven't seen yields this high in the last 15 years. So prospectively, it's making fixed income investors look a little more promising. In the bottom right-hand chart, it illustrates this, how in 2022, the traditional diversified portfolio didn't work out. So the first time in history, you can see represented here is just the aggregate bond index, and the S&P 500 was both negative. It's never happened before. And so you can see here, we think that this is a highly unusual time, and going forward, we think it's going to revert back to the normal. Then just a quick economic update, upper right-hand corner. This is just looking at the strength of the US dollar. As we've talked in our previous quarterly meetings, the dollar was continuing to strengthen throughout the year. And then you can see right at the end of September, there's been a drastic sell-off. So this has been a major benefit to any investors in the US investing abroad. So think of your global bond fund any of your international equities, it's been a nice tailwind for those strategies. And then at the bottom here, just looking at inflation, you can see both CPI and core CPI has begun to roll over. The one part of inflation that is still running very strong is represented in the lower left-hand corner, and that is just the renter's equivalents. It has not begun to slow down yet, and that is something that we anticipate, or at least hope to anticipate, that will slow down because we don't think that can persist for much longer, as it does really take a toll on the economy. Then just looking at the broad market index updates, you can see this is the first time in a long time we've actually seen positive returns across the board for the quarter. It's always nice to see. Starting on the left-hand side of the page, US core bond for the quarter up 1.9%. As I mentioned, though, down 13% for the year. So a very tough year. High yield, though, in the portfolio up 4.2%. As we saw in this risk-on environment within fixed income. So that was one area that did produce above average returns compared to the traditional bond markets. And then looking at the gray bars in the center of the page here, the equity markets, you can see large cap US up 7.2%, small cap up 6.2%. And the real outlier is when we were looking at the international markets here. International developed up 17.3% for the quarter. Very strong performance led by Europe. And it's really because of two things. Their winter months have not been as tough as we anticipated, and the energy crisis is subsiding. It's not as bad as they were anticipating. So that has been a very strong rebound in their performance. And then emerging markets up 9.7%, really led by China and the COVID easing, kind of taking a step back from their zero COVID policy, has led them to have very nice returns in the fourth quarter. And then hedge funds, as you can see here, last asset on the right-hand side of the page, up 1.3% for the quarter, down 5.6% for the year, but by far one of the overall best asset classes in the year, besides commodities. Any questions about the capital markets before we get into the actual portfolio and its results? Perfect. Seeing none, we'll jump right back in. Just one thing to hit on before the actual portfolio results. We discussed this at our last meeting, was the dollar cost average program of moving the $6 million contribution that was made into the short-term fund and moving proceeds into the long-term fund. So far, we have completed 3 stages out of the 4 in the dollar cost average program. We have 1 remaining left at the end of February. And then once that is complete, the final 4, the split will be $2 million allocated to the short term, $4 million to the long-term fund. Looking at portfolio performance on page 29, you can see for the quarter, portfolio is up 7.3%, in line with its benchmark at 7.4%. So nice to see a strong recovery there. And then on the 1-year number, portfolio is down 13.8% versus the benchmark that was down 15.2%. So although the portfolio is negative, good to see some relative outperformance versus the benchmark there. And then once we look out to longer term numbers, 3-year number outperforming by 70 basis points versus the benchmark of 2.8% versus the benchmark at 2.1%. And then in line for the 3-year or the 5-year, 7-year and since inception timeframe. What does that mean in dollar terms? Looking right here, the portfolio finished the calendar year at $22,630,000. Just putting that into perspective through yesterday's close, the portfolio is up again a little over 7% in the month of January. So very strong performance so far this month as well. Looking at the individual managers in the portfolio, you can see within the fixed income category, MetWest, it's one of your core bond holdings at a 14% target weighting. This is prior to the portfolio transitions. In line with the benchmark for the quarter, up 1.8%. And then we look at the 1-year number, did trail their benchmark by about 1.7%. This is really due to they had a slightly longer duration profile than the index. So we think that interest rates go up, bond prices come down, they had a longer duration, so they had greater interest rate sensitivity. So they're affected more when the rates increased. BlackRock, your unconstrained bond manager, had a very strong year, as you can see here, on a relative basis, beating their benchmark by about 7.5%. Looking at Brandywine Global Opportunities, this is the fund's global bond manager. As you can see here, as I mentioned, when the dollar was weakening in the fourth quarter, this is a tailwind for your global bond manager. So they took advantage of that, up 7.3% versus their benchmark at 4.5%. So very nice performance there. Also outperforming on the 1-year and 3-year as well. One manager that I just want to highlight though, within fixed income is BlackRock. It's still on discuss, as you'll see right here, our internal status. That is just because of Bob Miller, one of their portfolio managers, retiring at the end of the first quarter. This was well telegraphed. We don't have any concerns with it. The other co-portfolio managers are still in place. Rick Reeder is still on the team. So really just bringing this to your attention that it was well telegraphed. Everything's still in place and it's moving smoothly. Looking at domestic equity, you can see from a composite level, very nice performance on the quarter, up 8.1% versus the benchmark at 7.2%. Similar story on the 1-year, down 17.6%, but outperforming on a relative basis by over 1%, by about 1.6 percentage points there. So very nice on a relative basis, not so much on an absolute basis though. Diamond Hill, as I mentioned a couple minutes ago, we did jettison this strategy in January, but you can see on a relative basis versus the broad market, did perform very nicely while we own the strategy. So you can see from the 1-year number, outperforming by about 2 percentage points, and then also on the 3-year as well. So when we did have this value tilt on, it did work in the portfolio's favor. Both the large cap domestic equity and mid cap domestic equity portion of this portfolio is indexed. So as we anticipated, the strategies performed in line with their benchmarks. The large cap for the quarter was up 7.6%, and on the 1-year, down 18.1%. Similarly, mid cap up 9.2% for the quarter and down 17.3% for the 1-year. Both of these small cap managers in the portfolio performed very well. New addition as of the November to the portfolio is Hotchkiss and Wiley. Very strong performance right out of the gate for them. As you can see here listed on the far right hand side of the page, down 50 basis points or 0.5% versus their index, which was down 3.7%. So it's always good to see the managers getting off to a good start. This manager replaced your other small cap value manager, Boston Partners. So good to see them getting off to a good start. International equity, you can see here, similar story from a composite basis, slightly ahead on the quarter, up 14.5%. Similarly here on the 1-year, down 14.8%, while their benchmark was down 16%. So captured some nice relative outperformance there. MFS, your developed manager, did struggle a little bit on the quarter, down 1%. But when we look at their longer term track record, which you've owned, you can see up 2% or 2.9% versus the benchmark that is up 0.9%. And you look at their peer rankings here, top quartile, top decile, top percentile. And since you've owned them here, up 4.6% versus the benchmark at 1.5. So very strong performance here from MFS. Similarly here, looking at the dedicated emerging markets manager, Hartford Schroders, very nice quarter, up 10.5% versus the benchmark at 9.7. This is primarily due to China reopening and them being able to take advantage of some of those trades within China. This is why they were hurt on their one-year number, down 2%, because with China being in such a strong lockdown, they had an overweight to China, so that hurt them. But with China reopening, they were able to take advantage of their positioning there. Looking at the real asset section of the portfolio, no concerns with Cohen & Steers, your global REIT manager, performing in line with the benchmark. And then principal diversified real assets, similarly, very nice performance, especially over the 1 year, down 6%. Now that jumps off the page at a lot of people when we say that's very nice performance. But when we compare that to the broad equity markets, it's really protected nicely in this environment. When you compare it to the domestic equity market being down 14% and then international markets being down 6%, it's provided a nice hedge. Similar story within the hedge fund category, looking at Ironwood, up 1.3% for the quarter. And then we look at their 1 year number, which is you've owned them for 13 months, down 0.4% versus their benchmark at 5.2%. So performing very nicely on your behalf there. Any questions on the long-term portfolio before we take a look at the short-term portfolio?
Generous, man. Again, I appreciate the thoroughness. Obviously, one of the things we're looking either ourselves or for you to prompt is if there's anything that really is a significant outlier at this point, and it doesn't seem to be that way. So steady as we go. It's good to see, of course, the comparisons to benchmark all the way through, but we
Yep.
appreciate that.
Perfect. And then I'll just jump right ahead to the short-term portfolio. As you can see here for the quarter, short-term portfolio was up 1.1% versus the benchmark at 1%. On the 1 year, was really able to protect nicely, down 1.5%, while the benchmark was down 2.5%. So the active management that we had in the portfolio was really able to protect in the rising rate environment, especially on the short end of the curve where the Federal Reserve is really controlling when they're raising rates. Long-term performance in line with benchmark across the board, starting with the 3, 5, and 7 year timeframes. Looking at dollar values, at the end of the calendar year, the portfolio was at $9,829,000. Everything is in line with its target asset allocation. We purposefully have a slight underweight going to the TIAA CREF, Social Core Choice Bond. As you know, we've been as part of our dollar cost average program. If there's not any other questions on the short-term fund, I can open it up to questions from the rest of the group.
Mary Kate, any questions?
I think the only thing, Matt, with the quarter point that just happened yesterday from this, and I know you can't foresee, but anything on a short-term basis that we should be looking at and being prepared for?
Yeah, so what we anticipated at the beginning of the year was a 50 basis point increase in the first half of the year. Now, we thought it was going to come in 2 separate increments. So we saw the first one yesterday, and we also think there's going to be one more increase at some point. We do not think it's going to be a gap. So we do think it's going to be at the next meeting. And then we do think they're going to maintain this terminal rate for some time. Now, when you start to look at the Fed dot points, though, some of them are calling for one cut at the end of the year. I don't know if that's too rosy of a picture. Personally, I think we could be at this terminal rate for, call it, over a year.
Great, thank you. It's helpful.
I think for me, Matt, more just some observations, both with our board chair here and sort of the trustee outlook, and also with our fiscal team. I mean, when I when I add it up, 32.4, 32.5 million under investment. That's just so helpful to see, especially for John Tudor and Andrew, to know what our cash position is underneath that as well. Just gives us a lot of options as we're continuing to sort of work our way towards a sustainable outlook 2-3 years down the road. So it's just helpful, Matt, that we
Yeah.
know our investments are holding up, especially how we're managing our sort of annual budget work as well. I just wanted to check to see, given the size of the short-term position at almost pushing 10 million, do we have any other movement in terms of taking dollars from short-term and putting them into long-term? Did I miss that, or have we exhausted that process?
One more move at the end
Okay.
of February, so that you're at 9.8 million. Just assume there's no market movement. It'll go down to 8.8 million.
Okay. Okay, I mean, more so again, taking that long-term approach in a year, as we see again, when we reset on the fiscal year, we know where we are, and we know what enrollment looks like, when we know how investment's looking. With our board of trustees, again, I'm looking at John and Andrea, we may want to revisit again if we continue to have a large, relatively speaking, short-term position. We might want to revisit again an approach where some of those dollars go to long-term. Again, I'm just looking ahead, if this all holds up the way it is. Because obviously, I think, Mary Kate, for us, one of the things that we're seeing is, given budget management right now and given our cash position, with the vote by trustees to utilize reserves to balance our budget this year, we may not need to do a divestment. And again, I think that that's a fair thing to put out there on the record here in February, just so I'm checking that we have that clear, John and Andrew, with our investment manager right on the call.
Yeah, and I think there's just two things that we're keeping in mind as it blends both our local cash, operating cash, with the short-term portfolio, is our potential use of reserves to balance the budget, in addition to our Building 20 relocation efforts. Yeah.
That's it I had, Dr. Cook, unless there was anything else.
I just looked to the team again. I think I see my board chair shaking her head. I know I'm solid, Matt. Unless there's anything else, let me just check again with our team. Any other questions?
No, really helpful, Matt. Thank you for staying on track how important this is, as we, it kind of melds into all the work we've been doing from a strategic plan perspective too. Making sure that we do have the monies when we're ready to pull the trigger on really important buildings and transfers and relocations for the students. Really helpful. So I appreciate you.
Glad we can help.
Absolutely.
All right, thank you, Matt. Really appreciate the time. Look ahead. I'll have you talk to the team. I think we're back in I know we've got it on there, May. Maybe we're due for an in-person. Bring you up to campus, have a chance to shake your hand live.
Perfect.
So Mary Kate, just leaves you to take us out then.
That's right. So being I can call the motion and second it, Nanette. So thank you so much, Matt and everyone, for tonight's investment subcommittee meeting. And I do vote to close the meeting, Nanette.
That's fine.
Have a good one, everybody. Thanks so much.
Thank you.